going. There we go. So, welcome everyone. Welcome to the MTI Planning with Optimism. I'm Catherine Putney. I'm looking forward to talking about the economy today. And I know there's a lot going on politics-wise and maybe even coronavirus-wise. So, feel free to chime in with your questions as they come in the chat box that should be available to you. So, what we will start off with is just a generic macroeconomic overview. And before I hop into that, I do want to say and extend a big thanks to Tom Morrison, who always is very, very gracious and puts a lot of effort into creating these and putting together these webinars. So I do want to extend my big thank you to Tom Morrison from MTI to put these types of webinars together. Alrighty, so let's hop into the weeds of it. Let's talk about the macroeconomy. Now, the macroeconomy, the sheer size of the U.S. economy is so big, but when you look at the population, it's so different, right? So what we're looking at here is where the people are. This is looking at a global population standpoint, where the Asia and Pacific regions really, really take over the largest piece of this pie here, and I'll use my mouse for reference, so I'll circle over certain things. You can see the Asia Pacific really just take over the population-wise, and the North America itself, which is Mexico, the U.S., and Canada, 4.8% of the global population. That's kind of a sliver on this overall trend that we're looking at here. Now, the next slide that I'm going to show really hits home, right? So the United States, when we look at the size of its GDP, is 24.2% of the world economy. So we just went from 4.8% of the population to 24.2%, not even now excluding Canada and Mexico, 24.2% of the economy. That really goes to show the sheer size of the overall U.S. consumer. So know that the U.S. is the largest economy in the world. It will remain the largest economy in the world. I know a lot of people think China is the largest economy. It is not. You look at Japan and China with their one-child policies and the fact that there's an upside-down birth rate going on there. That's really going to make them struggle in the next decade or two. Last year, the sale of adult diapers surpassed the sale of baby diapers in the economy in Japan. That is very, very concerning to us. So the U.S. is not in the same kind of arena, but we're not doing excellent, but we're definitely a lot better than China and Japan. All right, so let's get into the weeds of it. Your type of business moves very well with what we're seeing here, and this is part of your report that you see. This is U.S. industrial production. So what we're looking at here is the left-hand side is historical data that is looking at the dark blue, as well as the right-hand side. The dark blue is the data that's happened in the past, and the teal bars there is data that is our forecast. That's where we expect the economy to move into the future. So know that we are heading into a downturn, and it's all about what you do with this information. It's all about, how can I capitalize on what's happening in the economy right now and making decisions to put myself on top of my competitors. This is the whole point of today's conversation, and we'll get more into the weeds as well of particular industries that you are all tied to, but you're still very much tied to the industrial sector. So we are seeing this general descent on my mouse here on the right-hand side going into this decline, and we expect a mild recession. And I say mild for a reason because it's not going to be comparable to the past, at least 2, 3, you can't see on the chart here, but at least the 2 last recessions that we're looking at. So things are going to be good in the next year. We got to be focusing on 2021 at this point. We're in the early parts, almost heading into 2Q20, that we should be probably focusing on 2021 at this point, and 2021 is good. We are looking at a good and prosperous year. So get your ducks in a row right now while you have the time, given the business that you're in, and we'll see that with the other charts that we're showing from your report, that you're moving very similar to what we're looking at here. Get your ducks in a row now. Focus on training. Focus on trying to make sure that all your capacity constraints are, eliminated, and things like that will really help you benefit on the top of the cycle as we head into 2021. So what are some of the reasons that we expect the economy to move the way that it's going? And we don't just throw, a dart at a dartboard and say that's where the economy is moving. We like to see evidence. We like to see what's going on. So what all of these lines that are about to pop up are showing leading indicators to the overall industrial economy. So every single indicator, every single line that's about to pop up has already been shifted to the right to accommodate for its lead time relationship to this blue line. And this blue line here is the macroeconomy. This is U.S. industrial production, and your businesses probably move very, very well with this trend here. So every single line that's about to pop up has already been shifted to the right. The diamonds there are our forecast for the economy, which is why the end of the solid blue line goes further back to the left than the end of the solid orange line. We've extended that solid orange line to the right, similar to what every other single line that is about to pop up is going to show. So this orange line is the ITR leading indicator. This tells us we're going to see some more decline, but it's not going to last forever. We also see the U.S. Purchasing Managers Index. This is one of my personal favorites, and I'm guaranteeing if you charted your data, your own personal data against this green line here, you'd probably be spot on with it. It's a very, very good indicator. I really like it, and the fact that it's recently troughed out is really good news that we're going to see that upswing as we head into the second half of this year. We also have the Wilshire market cap. This is a stock market related indicator that we're observing, and this is also in a general rising trend, confirming our expectations that we're going to see a turnaround as we head into the second half of this year. We also have the JP Morgan indicator as well. This is a macroeconomic indicator on a manufacturing level that tracks the activity in the manufacturing sector. This one has also turned around similar to the green line that you're seeing here in the PMI on the U.S. level. Really, really good news suggesting that we're going to see some upswing as we head into the next couple quarters. One of our fellow economists and analysts here at ITR created this really, really great chart. It's called the Overall State Opportunity Ranking Index. And it's looking at a multitude of factors, and it integrates, wage growth, it integrates multiple different factors such as new businesses started, population growth, unemployment rates. It integrates all these very different factors into one particular metric, and that's what we're seeing here. So the bottom left corner that you're seeing is the top 1 through 10 and the bottom 10. And the reason there's 51 is because DC is counted, by the way. So Florida ranks the first, and Vermont ranks the least. And I'm from New England, so there's a lot of New England states in here, so I'm not really proud of that. But it goes to show that there's a lot of good opportunity in those darker states that you're seeing on the map here, right? That means that if you're marketing your sales tactics on a national or domestic level, you should be targeting those bluer states that you're seeing, because that's going to create the more organic opportunities. It's going to create more of the natural, systematic opportunities that you'll be seeing compared to the more white-colored states where it's going to be much more difficult to find those opportunities. Let's quickly get into politics. I know that we are in the election cycle. It's 2020 right now, so I just wanted to dispel a myth. And you've probably seen this chart before, but I do want to kind of take a step back and basically say that we really are politically unbiased on our end. We look at policy, not politics, at ITR. This is GDP, the white line, the performance of the economy, overlaid on top of whether or not there was a president that was a Republican or Democrat at the time. We ran the numbers, even with Congress as well, not just the president, and there is no significant correlation between red or blue in the state of the economy. We look at policy. So we cannot say that the economy will do better because there's a Republican, red, or Democrat, blue heading into a certain direction. We just cannot make that claim. Warren Buffett said it best. You can look up top there, red or blue. You can still make green, and this is what this next chart shows as well. The presidential party versus policy. This is 1 year after the president took hold for each particular 4-year segment, and it showed the state of growth of each economy, of GDP, at the time. And what it did was it looked at, we averaged them out, and they're nearly identical. So we cannot say that red or blue has an impact, positive or negative, on the economy. We look at policy. We look at things like that. The economy is so much bigger than than Washington, than Capitol Hill. We're a $19+ trillion economy. You think that red or blue is going to influence the way that the movement of a $19 trillion economy is going to go? I really don't think so. So just keep that in mind as we head into the next cycle. But know that a lot of the people in the world will be more risk averse or more aggressive in their decisions because of the speculation regarding the political cycle that we're going through. So it's not enough to do your best. You must know what to do and then do your best. This is a big thing. It's not about me giving you the information. It's about utilizing the information to your advantage, right? So your particular industry that we'll see in a couple seconds here, but also the macroeconomy is in this phase C. This is what we call slowing growth. It's all about what you do with the information. And this is not an exhaustive list. This is just a laundry list of items that talk about what you should be doing in each particular cycle of the business. So now that the overall MTI is in this slowing growth trend, which we'll see soon, these are some of the things that you want to do. Start preserving your cash. That's a big thing. Cash is king in this particular phase of the cycle. Knowing which markets are going to go harder into recession, knowing which markets are going to be not as deep into recession, and we can help you with that. If you'd like, just let us know. But these are things that you need to be considering, because I can dump this data on you all day, every day. It's about what you do with the information that is critical. And the same thing for recession. This is the phase D recessionary standpoint. Very similar tactics here. I'm not going to read through these verbatim. I'm just going to say that this is the point in time where if you know that recession is going to happen, the buy low, sell high mentality is going to be really crucial. All right, given the type of business that you operate in, commodity prices are probably really, really important to you. So what we're looking at here is a lot of commodity price activity that we're seeing. All are pretty much down. I mean, copper is barely above zero, but still generally in the lower position. So what that tells us is that the economy is demanding less, because when the economy demands less in the law of economics, that means prices go down. And that's what we're seeing here with the pricing decline, and the negativity that we're seeing in the bottom right-hand corner here indicates that the global economy is in the slowdown. So prepare for that. Know that it's coming. All right, I'll spend about 5 minutes on this before I get into your own markets, but I know this is a big topic of conversation, is looking at the prosperity in the age of decline. This is looking at our expectation for a 2030 depression. This is not really reference to the near-term outlook for your business, but I've found a lot of interest that comes from this particular conversation, so I will hop into that. What's causing this 2030 depression? Our CEO and president, Brian and Alan Bolio, wrote a really great book called Prosperity in the Age of Decline that talks about all of these depression drivers, which is one, demographics. 10,000 baby boomers each and every day retiring from now until 2030. We have entitlement programs, which Social Security is under a lot of financial stress right now, and with those aging baby boomers into the era which is going to require a lot of demand for health attention and medical attention, that's just going to drive inflation up a lot more, which is going to increase our national debt. Because right now, I mean, we're at a high amount, and if we're not making changes, we're going to see just more and more and more. If we're not either raising taxes or decreasing our transfer payments, which is such as Social Security or unemployment, welfare, those types of tactics. If we don't decrease those types of payments, we're gonna be essentially, for the lack of a better word, screwed as we head into 2030. So this is kind of a painting a picture of what we expect for the next, let's say, 2 years or 2 decades. A lot of people thought that the Roaring '20s was rise. It was actually not. There were actually 3 recessions in the 1920s. Now, this is looking at the economy in the 1920s. This is not our forecast for the future, but it's a similar projection of the rise and decline. So we're seeing that rise, we're seeing that decline. I like to call this the stairway to heaven and then the highway to hell, essentially, as we head into that 2030 time frame, given the reasons that I mentioned before. And there are ways to make money off of this, right? You want to preserve or get rid of your debt. You want to take advantage of having assets, because in times of recession and depression, people migrate away from buying houses to renting. So if you have a source of cash inflow during times of renting, you have that cash coming in just in case, you lose it. Hopefully not, but just in case people are out of a job or you have a place for your kids to live as well. And this kind of shows that, right? So we see the red line on top and the blue line right below that. Those are the 2 I want you to look at right now. The red line up top is looking at current transfer payments. These are our payments such as Medicare, Social Security, unemployment, welfare to the everyday U.S. citizen. And the blue is what we take in for money. This is our tax receipts. Look at that delta. Look at the difference between that red and blue line. I mean, we're going to keep increasing our deficit if we don't make either any changes to those red or blue lines. So that's the form of what? It's either raising taxes, which is the blue line rising to close out that gap right there, or it's the red line declining, meaning we can't pay out as much. So that needs to happen to reduce our debt, but I don't think that's going to happen given the fact that I think it is somewhat political suicide. Because this is a 10-year out problem. Who's going to advocate right now to get the votes for re-election next year to prevent something that's going to happen 10 years from now? That's what we're looking at in this situation. The U.S. is a very reactionary country when it comes to politics and the financial situation. We're not proactive, we're reactive. So at this point in time, unless anything else changes, this is the information given to us right now, this is what we're thinking. This is a fun chart I just like to throw in here and there. Just looking at the interest rate environment, and it's 100% correlated to the Federal Reserve chairman at the time, their height. But Jay Powell had to come and ruin it, and he's taller than Janet Yellen. But we don't expect that prices will rise, or that the interest rates will rise all that much. I don't think we can really find anyone shorter than Janet Yellen. So at the end of the day, in reality, we don't expect a lot of movement coming from prices. All right, so finally, let's close it out looking at your own market. So what we're looking at here is MTI average monthly sales forecast. What we can see is you move very, very well with the B2B market, the business-to-business market. We're seeing you in this business cycle decline. Your quarterly growth rate is tracking just into that recessionary period. You can see on the right-hand side where my mouse is hovering over. We expect further decline coming from your business. So what this means is that you have to utilize the next 2 quarters, 3 quarters to your advantage to prepare for this upswing. Again, where my mouse is. Prepare for that upswing that you're going to see. And on the left-hand side, this is what you're going to feel the next, year or so might be a slowdown. Unless you're doing something differently, we're going to see some good rise from your overall aggregate of data. All right. And that's corroborated by the fact that because you move so well with this industry, with non-defense capital goods new orders, I'll go back here. This is what you move very, very well with the diamonds as our forecast. What's saying you're going to be in that direction? Well, you should be tracking copper prices because you move very well with that. You should be tracking small business optimism. That's also another indicator you should be tracking because look at how well, as of recently, you've moved with that market, right? I mean, seriously, the business optimism is extremely highly correlated to your business as of recently, as well as the utilization rate. The utilization rate in red indicates are businesses in manufacturing more busy, or are they less busy? And if they're less busy, that red line declines, which discourages new business on your end. This is why we expect more decline, because we're seeing optimism low, which is resulting in more risk averse. People aren't spending as much, or businesses aren't spending as much, and businesses aren't as busy either. That's discouraging activity to spend on your types of products or services. And then we have our ITR leading indicator as well. So all of it is really suggesting more decline in the next 2 quarters, but just prepare yourself right now for further rise because we're expecting a really quick rebound. It's going to be good news for 2021. Know that it's coming your way. So don't get discouraged. Use this time while you can. Utilize it for a preparation period to really reap the benefits of 2021 as it comes our way. Which ties us into corporate profits, right? If corporations are profitable, they're going to spend more, which is good for you, and vice versa. If corporations aren't profitable, they're not going to spend as much, and that's what we're seeing here. If you look at the top line, we're seeing a general plateau coming from overall corporate profitability, which indicates that there's not going to be as aggressive of a spend in the overall B2B market, which you are mostly all tied to. So on a numerical basis, you can see our reported data, your reported data through the past. And this makes a lot of sense. So if we look through the past, this is your historical data trend. It's been in a general descent for at least 3 quarters now, maybe even more than that if we took an overall line trend. But the last 3 quarters have been in descent. We expect that to continue for the next quarter or 2. This is what is important because we've already seen the peak in the rates of change in the business cycle well before we see the peak here in the top line data. So know that we do expect more decline to occur in your overall trend, in your overall business, as we head into the next couple quarters before things pick back up again. And this is essentially the image that I was showing. Again, this is reflective back to this is the same exact picture that I showed before. We're just kind of honing in again, knowing that you're going to see some more decline here before rise picks up. But look at this. I'll get my drawing tool out here. I would really like to use my drawing tool. So if I use my drawing tool, look at the level of this contraction right here. The last level, if I drew a straight line across, I mean, this is not even comparable to the majority, or at least 16, 17, and 09, 010. Know that this is going to be a very mild and manageable downturn. Don't get rid of anything that's going to sacrifice your capacity at all. So that's going to hurt you when things pick back up again in 2021. Again, this is the phase that you're currently in. I don't want to read through these verbatim, but you're able to access these. They're just kind of a laundry list of items to look through to implement in this slowing growth type of structure. So in summary, know that the first half of 2020 will be a low point in the business cycle, that we're going to head into a low point. 2021 is going to be a good year. And then 2022, we're on the backside of the business cycle again, knowing that we head into another downturn. It actually will be more severe than what we are in currently. So know that as we head into the next year or two, that the upcoming 2022 into 2023 downturn will be more aggressive than what we're seeing right now. All right, I would like to open up the floor to any questions at all. If there's anyone that wants to chime in here and there with anything, feel free to. There should be a chat box. Let me see. Yeah, there should be a chat box to submit your questions in the More tab, I believe. All right. I'm seeing one question come in asking about the impact of the coronavirus on overall trade and the overall impact on the economy. So what I'm seeing, I guess what I'm seeing there is that the coronavirus is definitely impacting the short-term impacts of trade. Long-term wise, it's hard to tell because we can't really predict the long-term of a health scare like this. But at the end of the day, short-term, yes, it is limiting the trade back and forth from the U.S. and China, and it has done some postponing on the trade war type of thing. But long term, I think that it will renormalize itself. The economy is so large in the U.S. I mean, we're a $19+ trillion economy. I don't think that it will really impact it enough to make any movements to shift the overall economic outlook. All right. The next question I have is, if we watch copper futures utilization rates and small business optimism as leading indicators, what is the lead lag time? All right, so I think I'm reading your question in the way that is what is the relationship between copper prices and utilization rates against the economy or against what your businesses do? So that's a great question. So I think it would be, given what I've been seeing against copper prices and the other indicators that we've mentioned earlier against your own type of business with MTI, it moves generally 1 to 2 quarters in advance. So it's hard to tell on a business standpoint, but from an MTI standpoint, when you aggregate all the data together, it's typically, I would say, 1 to 2 quarters behind the game. So when I talk about those pricing behaviors in the marketplace that I talked about today, that means your business will feel it 1 to 2 quarters later. So you lag it by 1 to 2 quarters. But it's different for every business, so I'm judging this off of MTI as a total. Any other questions that want to come my way? All right, well, I thank everyone for joining today, and I'm looking forward to doing this again in the future. So if you have any questions, I believe you have my contact information from Tom, and you'll have this recording of the webinar as well available to you. So feel free to reach out to myself or Tom, and we'll be able to answer any additional questions you have. And I hope you guys have a great rest of your week, and take care. Bye-bye.